Good afternoon and Happy New Year. It's Jeffrey Christian of CPM Group. It's a little after 1 o'clock in the afternoon on Friday, the 3rd of January here in New York. Gold is trading around $2,661. Silver has risen back above $30 right now, and platinum and palladium are up sharply. I want to talk about the outlook for the world and precious metals in 2025. We have named 2025 a consequential year. 2024 we had labeled as another year of living dangerously, and I think for the world that was true. And we think that in 2025 it's going to be a very consequential year. Now, by that we mean two things. There's certain two meanings for that. We think that there'll be a lot of consequences of past actions that will come to bear. That's true in the global economic and political realms, in the financial markets, as well as in the individual precious metals markets, gold, silver, platinum, palladium. In addition to that, I think that there'll be new actions which will have significant consequences for the world for many years to come, including in precious metals. I think that this is going to be perhaps a much more important year than some other years have been. It's going to be a major developments in our view. And there's a tremendous amount of uncertainty and lack of clarity as to what those developments are going to be, perhaps more so than in the past. Before I get into that, I want to do a little road lap here. It's been 50 years since I wrote my first piece on commodity markets. It was in 1975. I had gone back to university, and during that year, I wrote my first analysis of commodities. It was on the oil market and on U.S. policies toward oil. It's been 50 years. It's a long time to be doing something. But it also is interesting because there are certain parallels to what was going on in 1975 to what's going on now. As I said, that was an oil analysis that I wrote in the second half of 1975. What we now call Brent oil, which was ARA, Amsterdam, Rotterdam, and Antwerp crude oil prices, were trading around $12 in 1975. They had risen sharply. OPEC had started to assert pricing power in the late 1960s, and the price of oil had gone from about $1.50 to about $2.25 by 1970. In 1973, there was the Yom Kippur War, followed by a OPEC or OAPEC at least, embargo on oil exports to the United States, Europe, and other countries that had supported Israel in that war, which led to a sharp increase in oil prices from $2.20 in 1970 and subsequent years up to about $12 in 1973, 74, 75. There were also lines for gas. There were shortages of petroleum around the world. It threw the world into a deep recession that lasted from the second quarter, third quarter of 1973 into the first quarter of 1975. There was no Federal Department of Energy at the time. It was only created in 1977. Gerald Ford was president. Richard Nixon had resigned in 1974. And Gerald Ford created an Office of Energy Policy within the White House in 1975. But there was no Department of Energy. And in fact, around the world, governments found that they hadn't really spent a lot of time looking at the long-term supply and demand conditions of energy markets, let alone other commodity markets. GDP, as I said, we had gone through a deep recession from late 1973 into 1975. The depth of it was a 5%, 4.9% contraction in the first quarter of 1975. We started to recover sharply, especially in the second half of 1975. The federal budget had deficit had swelled. It gotten up to $53 billion. That was in contrast to the last budget surplus we had, which was in 1969 and $3.2 billion. It's very interesting because at that time, well, federal debt had surged to $542 billion and represented 11% of annual US GDP. And at that time, gold there was pressure on the United States to allow gold ownership, which was allowed at midnight on December 31st, 1974. The gold price had risen in 1973 and 74 in line with inflation, in line with investor demand elsewhere outside of the United States, and to some extent within the United States, due to the inflation, the recession, the surging federal deficit. And you had certain people start to appear who were saying, hey, these deficits and debt were unsustainable at $53 billion deficits and $540 billion debt, representing a walloping 11% of US GDP. And gold prices had to surge. And we were going to run out of oil and copper and gold and silver and a variety of other metals by around 1980 or the early 1980s. That was the situation in 1975 when I went back to university. I was studying journalism and international political science with an emphasis on international economics within the political science realm, looking at how communist countries trade it and how developing countries trade it. And that was 50 years ago. And here we are today, not too far down the road. Now, the formula for understanding gold and silver prices is that the prices are primarily dependent on investment demand. And investment demand levels and trends for gold and silver primarily are dependent on investor attitudes toward economic, financial, and political concerns and developments. The actual economic, financial, and political developments are important in flavoring the prices of gold and silver, but it's the investor's interpretation of where we are that is even more important. And you see that with a variety of economic data that come out on a regular basis. And the data is less important than how financial markets interpret the data. Higher interest rates. Oh, does this mean that the inflation is a problem and the Fed is struggling to get it under control? That's bullish for gold and silver. Or does it mean that inflation has risen and the Fed is effectively managing and controlling that by raising interest rates, which would be ostensibly bearish for gold and silver? And you see that sort of interplay between the actual economic events, how financial markets interpret it, and how that interpretation is reflected in gold and silver investment demand and prices. You see that today. Key is having a view on how gold and silver might most likely track. And in order to do that, you have to have an accurate, reality-based opinion based on actual economic and financial and political conditions, and as devoid as possible from opinions and beliefs and expectations and theories. Platinum and palladium are a little bit different. They're dependent on auto demand trends because auto is so important to them. They are really industrial metals as opposed to investment metals. And investor attitudes about that auto demand also is important. Now, looking at 2025, there are a lot of unknown factors. A lack of clarity and a high degree of uncertainty about what's going to happen is very prominent this year, more prominent than last year and more prominent than in many other countries, years. What we do not know is what's going to happen with the Republican Party over the next 2 years and the next 4 years. 2 years are important because we have the midterm elections. 4 years are important because you won't have a Trump running for president, most likely. And even if you do, it won't be Donald Sr. And if it's J.D. Vance, you probably are going to have a lot less groundswell belief and support for somebody other than Donald Trump than you've had in the previous 3 elections. But in the interim, you have 2 years and then you have 4 years. And during that period of time, it's not known what the Republican presidency and unified Republican government will try to do. They've said all sorts of things that are internally inconsistent. You really don't know what they're going to do. You don't know what they're going to succeed in doing. There are laws and Constitution, the Constitution and the laws derived therefrom, that prohibit them from doing some of the things that they say they're going to do. There is a Congress which may show some resistance. There is a court system which may show some resistance. And there's probably going to be a steady plethora of legal challenges to a lot of the things that they may try to do. And what they may try to do may not be what they've said they're going to try to do. And what they succeed in doing is not going to be exactly overlapped with what they try to do. So you're going to have that. One thing that you can tell, one thing that is knowable, is that lawyers will probably do very well challenging a lot of the efforts that are trans-constitutional. In addition to that, you have Republican congresspeople who are looking at their own careers saying, as I said earlier, regardless of what happens over the next 2 to 4 years, you're probably not going to have Donald Sr. running for president 4 years from now. And they're going to be looking at their careers. And they're going to be looking at what voters are going to think about them. If they slash Social Security and Medicare and Medicaid benefits and severely impinge upon the cash flow and living standards of maybe 150 million people, that could be very bad for them in the absence of a Trump leading the ticket, of Donald Trump leading the ticket. So you're going to see congresspeople in Republican congresspeople starting to look at their own best interests as opposed to following it. And you're actually seeing that today. As I speak, the House of Representatives is voting on a speaker. And they need all but one Republican in order to elect a given speaker. And there are about 16, as of this morning, Republican House of Representatives saying that they probably would not support Speaker Johnson continuing as a speaker. So you're going to see a Congress that is perhaps a little bit less willing to give the administration everything that the administration might want. In addition to that, you have other social and political pressures outside of the Republican Party that have to be paid attention. And you have to see what non-U.S. entities will be doing, because the whole world's in play. We have a constitutional crisis in South Korea right now. We have difficulties forming new governments in Germany and France. You have Russia at war with Ukraine and suffering from 25% inflation and super high interest rates and a massive decline in both domestic and international support for the Russian government. You have a Chinese government that is wrestling with its own issues. You have the ongoing war in the Middle East, and it's very concerning what might happen between now and January 20th, 17 days within the Middle East conflict between Israel and some of its Muslim neighbors. Muslim, not Arab. very important to understand. We do know a couple things that will happen. There's going to be a lot of uncertainties and a lack of clarity, and there's going to be a abundance of buffoonery and dishonesty and inaccurate information, not only politically and economically, but also with precious metals, which leads me to where do we think it's going to go? Before I do that, I just want to have one quote from the House Ethics Committee report on Matt Gaetz from 2 weeks ago. The House Ethics Committee report had this sentence in it: Representative Gaetz has acted in a manner that reflects discredibility upon the House. Yeah, to discredit the House of Representatives or any branch of the U.S. government at this point in history, that's a really low bar. I think it's kind of funny. Now, we have been projecting a recession for 2024, 2025 as the most likely occurrence. It did not happen in 2024. In fact, we saw stronger economic conditions in the United States than a lot of people, including CPM Group, had been expecting. That doesn't preclude a recession this year or next year. And in fact, it's more likely sometimes we slide into a recession, but more often than not, we go into a recession after a period of economic strength. And you get imbalances built up, and you'll run a bigger risk of fiscal policy mistakes and monetary policy mistakes that can trigger, along with other economic factors, a recession. So we're still assuming that there's going to be a recession. We have been writing in reports to our clients about the high degree of uncertainty there. And the big questions remain: when might we see the next recession? There will be a recession, 100% certainty of that. When will it occur? How deep will it be? And how long will it last? We've actually gone from projecting a severe recession to a less severe recession to now a more severe recession in this period of time. And importantly, and I've mentioned this in previous videos, after the recession, say 2027, 2028, going forward, these are our 10-year projections. Going forward, we think that economic growth in the recovery and expansion period will be subpar compared to what we've seen after the recessions from 1980 through 2008. So we're looking at a relatively hostile economic environment. Now, people might say, well, there's a lot of strength in the economy, stock market's doing well. The stock market is not the economy. And I want to throw out another metric, because people were saying, over the last 2 years, 2023 and 2024, the stock market, the S&P 500, has risen more than 20% in each of the last 2 years. And that's a very rare occurrence. I think the last time it happened was in 1997, 1998. But perhaps the first time it happened after they created the S&P 500 was 1927 and 1928. The Roaring Twenties, you had an incredibly strong stock market in the 2 years prior to the onset of the Great Depression. So strong economic activity 2021 through 2024 does not preclude a recession. In fact, you could argue that it actually makes a recession more likely sooner rather than later, because of the inherent strength that you've seen for a period of time. So we're still looking at a recession. We have increased uncertainty and increased or decreased clarity as to when and how that might occur. But it's our expectation that it's still going to go on. Looking at gold, gold prices rose very strongly in our quilt of, we have like 9 asset classes: stocks, bonds, real estate, cash, from around the world. And then we add gold and silver there. Gold was the top performer last year. Silver was the third best performer. Gold did very well last year. It did plateau after the end of October, and it's been moving sideways in somewhat volatile fashion, especially in November. December saw a little bit less volatility. And in the first two trading days of this year, we've seen gold and silver prices flop around within this range, still looking for direction. Our expectation, given that we think that inflation will come down, interest rates will be flat, the dollar will be stronger, economic activity, we might see an onset of a recession, and then there's this great deal of uncertainty as to what really will happen. Our expectation is that investment demand will remain strong, which will keep gold prices moving higher, and we'll probably see record gold prices again in 2025, having seen record gold prices in 2024. Central banks have been buying gold. Central bank gold purchases have not been as strong as a lot of people have been saying. In addition to that, you only have about 20 or 22 central banks that have been buying gold. It's not a broad-based thing. You have 180 plus central banks in the world, and only about 20 of them have been buying gold between 20 and 25 over the last several years, 2021 to 2024. So it's not a broad-based move into gold by central banks. And many of the central banks that have been buying very little gold. Yeah, 100,000 ounces, 500,000 ounces, 600,000 ounces. There have been a few that have been larger buyers. China, Russia has been going back and forth, Turkey, Kazakhstan, India. But it's not as broad-based central bank gold demand as people think. And there have been an increased number of central banks selling over the last year or so, especially last year, reflecting the fact that central banks do own gold. And with gold at record prices, some central banks were taking some profits. Other central banks were selling gold because they needed dollars to pay for imports, their net imports. So it's not that big. Similarly, there have been a lot of people talking about how gold investment demand in North America has not been rising as strongly as they thought or as strongly as you've seen elsewhere. And that's not exactly true. Gold investment demand for physical gold has been relatively strong. What we have seen is investors moving away from ETFs to owning physical gold directly. And this is a phenomenon that's really been going on for the last 4 years. It's not that those investors are necessarily that are selling ETFs are necessarily bearish on gold. In some cases, these are investors who have bought gold over the last several years through ETFs, and they're taking their profits. In other instances we know of from talking to the investors, institutional and high net worth individuals, what we're seeing is a movement away from counterparty risk. When you own a gold ETF, you're not owning gold directly, you're owning shares in an offshore company that is managed by financial institutions. And over the last 4 years, we've seen investors saying, I'd rather own physical gold directly, even if it means paying storage fees, than owning a gold ETF share, which gives me counterparty risk to financial institutions. So we haven't seen investment demand in North America as weak as some people say. We think that the ETF activity is masking that, but ETFs represent only about 8% or 9% of the cumulative amount of gold that investors own worldwide. And the demographics of gold ETF investors are quite distinct from the demographics of people who own physical gold directly. And ETF investors often are much more transaction and trading oriented, whereas physical gold owners tend to be long-term insurance holders. They see gold and silver as insurance policies. So we haven't seen investment demand as weak as some people say, and we haven't seen central bank demand as high as some people say. Silver, very similar situation. It didn't perform quite as well as gold on a year end to year end basis on a percentage average price percentage change in the average price. I think silver outperformed gold. It did show greater weakness in November and December than did gold. There has been some disenchantment in gold from investors who bought gold back in, say, 2021, 2022, based on the idea that gold was going, silver was going sharply higher. And when that didn't happen, but the price rose again sharply above $28 after in the third quarter and fourth quarter of this year, you saw some investors who had bought earlier sell their silver either to take profits or to recoup some of the losses that they had held on their books in 2022, 2023. Platinum and palladium, much weaker. They, again, reflect weaker auto demand. They are losing market share to electric vehicles in the all-important auto catalyst market. In addition to that, you're seeing demographic changes in the auto industry and cyclical reductions in auto demand, so that you've seen weaker demand for platinum and palladium in the auto industry, reducing fabrication demand. And then you've seen weaker investment demand as investors have focused on that weaker auto demand. As a result, platinum and palladium have shown greater weakness. Platinum, you can see from the right-hand chart, from 2015 through 2000, well, now, through 2020, platinum traded between $800 and $1,000. It moved into a higher range of $900 to $1,100 for most of the last 4 years. And it has been testing the low ends of that over the last few months. Our expectation is that it will continue to move sideways with a downward bias because we do expect the automotive demand to continue to weaken in 2025. And if that's our case for platinum, it's even more so with palladium. Palladium, of course, did not move sideways in a narrow, low range from 2015 to 2020. It actually rose very sharply to record highs. And since that time, it has come back off. And it's been trading in a range of 800 to 1200 over the last year. Our expectation is that it has more downside. This year, we will be coming out with our gold yearbook late March, silver yearbook late May, platinum group metals yearbook in late July. We will have our platinum, our PDAC silver reception during the Prospectors and Developers Association of Canada conference on Sunday, March 2nd. And we will have our online seminar on silver facts and fantasies the previous Thursday on the 27th of February. That is something that we started with when the onset of COVID caused the 2021 PDAC conference to be canceled. And we have a little report that we come out with, basically a summary of where we think the silver has been in 2024 or where it's going in 2025 at that time. And we are talking to various entities about a silver seminar tentatively in late October, tentatively in Boston. We hope to lock that down in the first quarter of this year. There are questions that we get when we post these videos. And so, like one of the questions in our last video for 2024 was to address the issue of futures markets. They didn't say it that way. They said something like, why is there so much? Can you explain why there's so much paper, gold, and silver relative to the physical market or something like that? We've explained this repeatedly in videos, in presentations at conferences. There's a lot of stuff on YouTube. And one of the things we hope to accomplish this year is to create an index of all of the videos that we have posted on YouTube. Because rather than plow those same fields over and over again, we'd like to be able to point people to them and say, well, there's a 90-minute a presentation from the Silver Symposium in 2022, in Spokane that explains all of this. And there's a report that we've done and such. In 2005, I wrote a book, which was published in 2006, called Commodities Rising. I didn't pick the name, the publisher did before he read the manuscript. It's a very good primer on commodities markets. The first half of the book talks about the role of commodities in the economy, the role of the economy in the commodities markets. There is some discussion about why and how futures markets were created, like in the 15th or 16th century, by merchants who were looking to hedge their exposure. It doesn't address all of those things, but it's a very good primer on commodities markets and investing in commodities. The second half of the book, it's dated now because it was written in 2005, talks about a dozen different commodities: precious metals, base metals, agricultural commodities, and energy commodities, I think, are the four categories that we talk about. It's a good book, kind of hard to find in print these days. Amazon says they have one copy, but it is available on Kindle. So you can get it as a PDF, a downloadable book. You can buy it from via Amazon. Interestingly enough, when the Kindle version came out, it was one of the best sellers for financial market books, like ebooks, for a few weeks. And yet the publisher never managed to have any profits that they could share with us under our royalty agreement. But that's the nature of book publishing, always has been, always will be. It's there. Hopefully we'll be able to get that to you, but rather than go over the same things over and over again, we would encourage people to go to YouTube and search CPM Group, and you'll find a variety of educational videos from the last umpteen years, as well as interviews and presentations that we've done. That's all I have for now. As always, you can go to our website, cpmgroup.com. You can pre-order the 2025 yearbooks. You can buy the 2024 yearbooks. You can send us emails, talk to us about how we can help you manage your exposure to commodities. Best wishes for 2025. It's going to be a consequential year, and it's going to be a year where we should all walk as carefully as we would walk in a swamp that has quicksand in it, because this will be a consequential year. Thank you. Take care of yourself. Take care of people around you. We'll talk to you next week.